If you invested $100 in a single stock 20 years ago and did absolutely nothing, no checking, no trading, no panic selling, that $100 could be worth thousands today. And yet, most people who invested that same $100 in that same stock over those same 20 years lost money. Why? Because they did what 97% of people do. They used stocks wrong. And Panda is going to show you exactly what they did and how to never make the same mistake. The big confusion. When people hear stocks, they picture watching charts all day, guessing which line goes up, panicking when the screen turns red. That's not investing, that's anxiety with Wi-Fi. Here's what almost nobody explains properly. A stock is not a ticker symbol, not a bet on tomorrow's price. A stock is ownership, a tiny piece of a real business, real products, real customers, real profits. When you buy a stock, you're buying a piece of something real. Remember that. It matters more than anything else. Imagine a panda opens a bamboo shop. Business is good. He wants to expand. But he doesn't have enough bamboo. So he tells other pandas, "Give me bamboo now, and I'll give you a small piece of my shop. When my shop grows, your piece grows too." That small piece? That's a stock. Not a lottery ticket. Not a gamble. Ownership. Now here's where people mess this up. The 97% mistake. Most pandas treat stocks like slot machines. Here's what they do. They hear a hot tip. They rush in excited. The price drops 10%. Their stomach drops too. They check every hour. They feel sick. They sell just to stop the feeling. Then the stock goes up, and up, and up. They blame the market, but it wasn't the stock. It was impatience wearing a finance costume. Let's talk proof. Great companies have had massive drops, 50%, even 90%, but they didn't stay down forever. The pandas who sold during the drops locked in losses. The pandas who did nothing? They own the forest now. Same stock, same time. Only difference? Behavior. The 3% approach. Here's what the 3% do differently. It's almost disappointingly simple. They look for good businesses, not hot tips. They buy steadily. And then, they do almost nothing. They wait, not weeks, years. They understand one rule. Time does the heavy lifting. Here's something wild. Studies have shown that some of the best performing accounts belonged to people who forgot they had them, or people who passed away. Dead investors outperform active traders because they can't panic sell. The less you do with great stocks, the more you often make. But what about crashes? Markets crash. They always have. Every time pandas panic. Every time pandas sell. And every time the market eventually recovers. Higher than before. The pandas who held? Forests. The pandas who sold? Buying back later at higher prices. Crashes aren't the problem. Panic is. The 3% see crashes differently. Bamboo shops going on sale. The mindset shift. Most pandas ask, how do I save more bamboo? The 3% ask, how do I own more? The panda who only saves is always chasing enough. The panda who owns forests wakes up with more than yesterday, not because he worked overnight, but because his forests grew while he slept. Same bamboo, same starting point, very different future. 3 rules. Rule 1. Stocks are ownership, not lottery tickets. Rule 2. Time is the cheat code. Patience beats panic. Rule 3. Crashes are sales, not disasters. Those 3 rules separate the 3% from the 97%. So now you see the pattern. Debt borrows time. Interest prices time. Stocks use time. Same system, different tools. In the next video, we'll break down 2 different approaches to investing. Why one builds wealth and the other mostly builds stress. Before you go, are you in the 97%? Or are you starting to think like the 3%? Drop your answer below. See you in the next one.